It's 10:54, Tuesday, May 15th, 2012. I'm just looking at Crude, and this is Crude without anything on it. I've only drawn two trend lines. There's no indicators. There's no support and resistance levels. There's nothing. There's just a trend channel, and the only way you could have traded this is if you had this trend channel in place and it's weak. There's only 2 points. You could have sold the break of the trend line and capture this move down here. But let's take away any technical analysis, because drawing trend lines is technical analysis. So how could you have sold the top? Well, that green candle right there at the very top, its shape is what makes it a spinning top. It shows indecision because you can see that the market opened at the lower part of the body. It went down, it made a high, and it closed right there, very close to where it opened. Just real classic indecision. So let's look at my oil chart with technical indicators on it and trend lines. Look, this red level here, if I scroll back just so you can see, that's the previous day's high on the 14th, but it was also a low on the 11th. So where that got a support there, it got crossed once. You've already seen the cross. There it acted as resistance. That's called a classic trade. And then here, for a second time, we found resistance again. But also this blue line is the only down trend line resistance. It's the third test. You always got to connect 2 points to look for what happens at the third test of the trend line. With horizontal levels, you just got to put them on individual most obvious highs and lows. But with trend lines, you got to have 2 points. And if I go to the 10-day, to the hourly chart and show you 10 days, you can just see that here's where that trend line starts. It starts on the 3rd of May. It tags perfectly right there. This is the hourly chart. That's the 11th of May. And then we're looking right here today where it was perfect resistance. So let's go back to the 5-minute chart. So that is what I call a cluster setup. It's just the junction of a horizontal and a trend line. It's confluence, which gives strong resistance. That's where we could expect a price reversal. But an RSI, which is an indicator for momentum, there's no signal. Look, price is going up, and I'll put a line here to show you that RSI is going up. So in the 5-minute time frame, price and RSI both agree because RSI is calculated from price, and more than often they follow each other. So in this time frame, there's no drop of momentum because price is trending up, RSI is trending up. I know I repeated myself, but you get the idea. So now we got to drop down to the 1-minute time frame to look for a signal, because that's part of my methodology on hunting down price reversals. So we go to the 1-minute chart, same place. Now look at it. Here is that third test of the trend line. Here is the previous high that was also support on the 11th. And look at the signal now. Let's take away our 5-minute signal, the black line, but look at the drop in momentum. It's dropping 11%. So RSI drops from 81.9 to 70.55. Now, it didn't cross the 70% boundary, which is overbought. It's 70.55, and my back testing shows that signals more than 5% that cross either the 70 or the 30 levels, which is oversold, gives the strongest signal for price reversal. However, crude came off from 95. Oh, it's also another level. Look, it's 95.00. So let me edit that. That's a psychological round number, which I totally missed. So look, 95.00. So we have 3 levels there acting as resistance. And I wasn't up this morning to see this trade, but you can see how lovely it was. And we come off from 95.00 down to 94.2. So say one contract on crude, which is $10 per tick, 80 ticks. That's an $800 trade that you could have taken, and your stop could have just been 20 ticks, just above that high and outside the Bollinger Band. So you could have risked $200 and made $800, which is a 4R trade. R is what you risk, and the 4 annotation just says you've made 4 times what you've risked, which is a huge trade. And the turtles, in their methodology, if I get my sheet the turtles only had a small percentage of 4-hour trades. On just a little sheet I got here, they only had 2.2% of 3-hour trades. So the 4-hour was half that. It was at 1%. And 4-hour trades are hard to catch. But you can do it using Confluence and RSI, I believe. And that's what I call a low momentum price reversal. There was no signal in the 5-minute chart, but there's a clear signal in the 1-minute chart. It makes it low momentum. High momentum would have been RSI divergences in the 5-minute and the 1-minute charts. And obviously, if there was no divergences in the 1-minute or the 5-minute, we would have had less predictive value. So here we have predictive value offered by 3 levels: trendline resistance, psychological 95, par, and previous day's high. So 3 levels, and add the 4th signal, which is the 11% bearish divergence. That's 4 signals to sell short crude right there. That's how trading works with my RSI methodology.